Welcome to the Skillick Explains Finance video. This week, 3 ways a personal pension can save you tax. Now, the challenge is what exactly? Well, basically over an investing lifetime, you should aim to minimise the 3 big personal taxes. As a quick reminder, what are those? Number 1, income tax on dividends and or interest. Now, you pay income tax on your earnings, salary and so on, but here we're focusing on investment, so dividends and or interest income. Number 2, capital gains tax on the sale of any investments that you basically sell for more than you bought them for. And thirdly, one that's sometimes forgotten, but shouldn't be in the context of pensions these days, inheritance tax on your death estate. Now, I'm going to argue that personal pensions are not the be-all and end-all, but they're pretty tax efficient on all 3 bases, played correctly. Now, let's have a look at that. So saving tax on the way in, let's focus for a moment on income tax and capital gains tax if you like. So personal pension basics, for those people who've forgotten, money can go into a personal pension, say a self-invested personal pension, from an employee and an employer. And what will happen to it is basically the contributions that are paid in will get some tax relief. Let's take a quick look at that in a moment. Hopefully get some growth on top, assuming the performance of the investment is decent. There'll be some charges to pay, and that will give you the total value of a fund available to you when you stop work. Now, this is known as defined contribution or money purchase, so lots of different labels. But let's take a look at that tax relief. A reminder for some people and just a note for others, because that's quite powerful. Basically, the way this works is if you're a basic rate taxpayer, every 80p that you pay in can become £1 invested. How? Thanks to basic rate tax relief, given at source, claimed by the pension provider. So that's all quite neat and tidy. And it's quite difficult to think of many situations where you get that immediate boost to the value of the fund. Now, admittedly, there's investment risk once it's invested in, say, equities, but nonetheless, any gains that you make within the wrapper, say the self-invested personal pension wrapper, are tax-free from both income tax and capital gains tax perspectives. Now, the picture gets even better for a higher rate taxpayer because the money going in, subject to annual limits that are taper contributions for high earners, for example. Let's assume we're leaving those to one side here. Basically, as a higher earner, every 60p that goes in could become £1 invested. Now, you need to be careful to get this one right because the first 20p is given at source, and then you need to remember to make a self-assessment claim for the other 20p and then reinvest it. So it's a bit fiddlier, but in principle, 60p can become £1 invested, and that is a pretty serious upfront kicker. Then, within the wrapper, tax-free growth. So no income tax to pay on your investments and no capital gains tax whilst they remain within that tax wrapper. Now, saving tax on the way out. So at some point, you're going to want to potentially withdraw from this pension fund. So let's take a look at that. Pension freedom basically says you can withdraw up to 25% tax-free, and you can do it in 2 ways, at least 2 ways. You can do it all at once, if you've got a bill to pay, something you need the money for, or if you're thinking I need to supplement my retirement income, you can spread it. All right. You can draw down income, capital, or both. So beyond that 25% lump sum, let's say you can draw off income, capital, or a mixture of the 2 to fund your retirement, and or you might convert some of it. You don't have to convert all of it anymore beyond that first 25% into an annuity. So a lot of flexibility, a lot of freedom. Now, worth remembering, as somebody looking to save tax potentially, particularly income tax here, as a retiree, you've got an £11,500 personal allowance, each as a married couple, let's say, in the tax year 2017-18. So there's a chunk of it sheltered for a start. You can still receive some interest and dividends tax-free. There are separate interest and dividend allowances available to you. And past state pension age, you're not liable for national insurance. All right. So, given that you can also spread that 25% tax-free lump sum over subsequent years, there are strategies available that could see you pay very little or no income tax in retirement. Now, saving tax for future generations. It's tempting just to focus on the income tax and capital gains tax benefits of pensions, which are decent. But there's another one, inheritance tax. And people are sort of cottoning onto this one. Now, inheritance tax is pretty brutal. On death, it's payable at 40% on your death estate, with very few exceptions, basically. The estate includes property, investments and cash, less any outstanding debts on death, but it does include individual savings accounts and lifetime ISAs. So although those are quite tax-efficient vehicles in other respects, income tax and capital gains tax, they have that drawback where inheritance tax is concerned. Personal pensions, on the other hand, fall outside of your death estate for inheritance tax purposes. That means they can be passed on potentially to any beneficiary IHT-free, but The catch is the recipient may still be liable, may, I stress, for income tax. Why may? Let's take a look at that now. So here's an example. Basically, we've got a man who stops work age 65 with a property portfolio and a self-invested personal pension worth £250,000. Now, he's in a fortunate position because basically he's able to live off his state pension, all right, and the property income from the property that he's got, so he can leave his SIP fully invested. So that's safe. He's not drawing on that at the moment, if you like. He dies age 74. What would be the situation in terms of his beneficiaries? Or he dies age 76. Now that gives you a clue that something changes age 75. And under the current rules, it does. So let's just take a quick look at that now. So for AHT purposes, basically, his basic state pension is irrelevant. Basic state pension is irrelevant here. His property will be usually part of his death estate and subject to IHT. But his SIP can be passed on IHT-free to anyone he nominates. Doesn't have to be a spouse, could be anyone he nominates potentially. So there's a useful thing to bear in mind and contrast with ISAs and lifetime ISAs, for example. Now, why do I talk about him dying before and after the age of 75? Well, if he dies before 75, the way the rules work is there's no IHT, we've established that. All right, his heirs can draw down the £250,000 as a lump sum or income or leave it invested. So complete flexibility there. All right, and they may in time even pass the fund on themselves to future other beneficiaries. So you can have intergenerational tax efficiency with pensions. Now, if he dies age 75 or over, there'll still be no IHT due on the value of the SIP, all right? And he can still nominate any beneficiary potentially, but his heirs will be subject to income tax at their marginal rate on withdrawals, whether as a lump sum or as income. So there's the slight sting in the tail, but it is income tax, and only at their marginal rate, which might, for argument's sake, be the basic rate of tax. All right, and in time they can still optionally pass on that asset as part of their own legacy planning, IHT-free. Now, one complication is the lifetime allowance. So when planning use of pensions, legacy planning and so on, it's important to bear this in mind. And I'll mention it here. This is separate to any IHT headache. It's a separate headache, if you like. Basically, an LTA charge applies with the value of a fund, that is a pension fund, a save fund, exceeds a certain limit. Now, that is 1 million for 2017-18. The test is triggered by what's called a crystallisation event. So people sometimes say, when do I know I need to test the value of my fund against the 1 million? Well, we'll come to that in just a moment. And the amount of the charge depends on how the benefits are taken. So the way to think about this is a separate planning challenge to inheritance tax. It's something that's got to be sort of managed alongside it, if you like. Now, let's take a look at that. Crystallisation event. So what would trigger the test, basically? Am I above or below the million, is what I'm saying here. Making a withdrawal from the fund is one. Reaching the age of 75 requires potentially a retest. And death is the third situation. And the actual amount of the LTA charge depends. If funds are withdrawn as a lump sum, it's 55% of the amount above 1 million, if you want to see it that way. If funds are withdrawn as income, it's only 25%. But if you're thinking, well, that's a no-brainer then, what you want to do is withdraw any funds that are above the LTA limit as income. Be careful, because any income taken that way is taxed at the recipient's marginal income tax rate. So the 25% charge goes out anyway, and then there's income tax on top. Covered a lot of ground there, a lot of tax planning around pensions. So any questions, editor@killick.com. And if you'd like to see some of the topics I mentioned briefly here in more detail, killick.com/learn.